Let's talk money. Mary Holm is here. Hello.
Hello, Jesse.
Nice to have you in.
I think maybe your voice went a bit funny because you sang a bit earlier on.
Oh, well, I can't resist.
Which was wonderful.
I can't resist the opportunity to sing a bit of Neil Young on national radio.
Indeed. That's great.
You are going to address a question which is on a lot of people's minds at the moment, which is what to do about our mortgages and our mortgage rates.
And before we oversell this, I'm not going to give a sort of definitive answer, like put the whole lot on 3 years or something like that.
I'm sure every time you hear me promote one of your appearances, you think, Jesse,
yeah.
don't give the wrong idea.
Yes,
I'm not going to tell people exactly what to do.
Exactly what to do, because I don't know. If I knew, I would.
Yeah.
But
well, you can tell them everything that they should be thinking about and
Yes.
what they should be basing the decision on.
Yeah, and some ideas to think about. I wanted to start with pointing out why it's so hard to tell people what is a good thing to do with their mortgage. And I read recently Tony Alexander, who used to be the chief economist for BNZ for years, and now he's out on his own. But I liked the way he put it. He said, the guesses we economists make, predictions, are based on our knowledge of what happened in the past. Does this mean we should ignore predictions of what borrowing costs might do? God forbid, as then people like me might have to find real jobs. So he's pointing out, how hard it is. And he goes on to say, people should pay attention to the fact that when the interest rates are unusually low, they will go up. And when they're unusually high, they will go down. People don't seem to get that message, although he says it's pretty unlikely they'll go down again as low as they were in the last couple of years. That was because of worries about deflation and the pandemic. Rates got extraordinarily low. But he said still, the mortgage rates are going up now and that won't necessarily continue. So
I remember brokers telling me, they would be going through the numbers and I'd say, well, what if the interest rate goes up? And they'll say, look, I can't tell you for certain that they won't go up, but they're not going to go up.
Yes, and they weren't always right, probably.
Well, they're not now.
No, no, that's right.
I certainly remember someone telling me that we're now in an era of permanently low rates.
Really?
Yeah.
Yeah. Well, yes, we're not. Obviously.
So I can see, Mary.
And Tony, one other thing he said was, don't make panic decisions on the basis of whatever was in last night's news, because it's so easy for, the inflation figures came out the other day and they were higher than expected, and so suddenly everyone, oh God, what does that mean? And no one really knows. And so in the end, I think, and this is the same kind of advice or suggestions I make about a whole lot of things, is that you want to spread your risk out.
Yeah.
It's like diversification and investing. So with a mortgage, it can be a pretty good idea to get, say, some of it on 1 year, some of it on 2 years, some of it on 3 years. Not putting all your eggs in the one basket, because we just so hard to know what's going to happen to interest rates in the next year or two. Some possibly floating. It's interesting. In Australia, their floating mortgage rates tend to be lower than fixed rates, and in New Zealand it's the opposite. And it's not clear why. So most New Zealanders just look at the floating rate and say, I'll blow that. I'm not going to go with that because it's quite a lot higher. Although I had a look at a graph on the Reserve Bank website, and back in 2009 to 2012, floating rates were actually lower than 2-year rates, and for some of the period they were also lower than 1-year rates. And that has happened a couple of times since, including this year. From April to June this year, floating rates were lower than the 2-year rate. So people would be silly to always assume that floating rates are always higher and just not even look at them.
Yeah, there's no rule.
No, there really isn't a rule.
There's a brain's trust at the bank working out what's best for the bank and then doing that.
Yeah, and looking at the competition and so on. Yeah. And one of the advantages of being in a floating rate is that given rates have gone pretty high lately, eventually they're going to go down again. And if you're in a floating rate, you get that benefit straight away. As soon as they go down, you don't have to wait till your 1 or 2 years is up. And so If I had a mortgage, and luckily I'm very lucky I don't have one anymore, I would probably have some at floating. I mean, another advantage of a floating rate is that if you do suddenly get some money from, a redundancy or inheritance, or you win lotto or something, you can pay that money off straight away. You don't have to wait till the end of the term. With a fixed term one, you can pay it off straight away, but there's usually a penalty to doing that. So there are, so don't
Not much of a
dismiss
penalty
floating.
at the moment, I don't think.
No, you're right. Well, there wasn't when rates were going up, but we can't automatically assume they're going to keep going up from here. It's anybody's guess, really.
Not wanting to divulge too much personal information, but I did approach the bank earlier in the year when we got an unexpected little surplus of money, and I said, how much would it cost me to make a payment on our fixed mortgage, an extra payment? And the answer was $20.
Really?
And I think it's
cover
because
the admin.
Well, the sooner you paid off your fixed mortgage, the better at the moment, right?
Yes.
Because then they could get you on to one of the new rates.
One of the new higher rates,
Yeah.
yes, that's right. People your current fixed rate will have been set a year or two ago, and yes, that's
They won't be
quite
at all
right.
worried about it getting paid off early.
No, they're quite happy to get the money back. That then they lend it out at a higher rate.
Yeah.
When rates are going the other way, that's when you can cop big penalties for paying it off early. So that does vary. And I should also say that there are a group of mortgages that I call kind of fancy mortgages, revolving credit, redrawable mortgages, offset mortgages. And you and I talked a bit about this, and we'll get back to them before the end of the year. We'll have another session on those because they're interesting and they work quite well for some people, and people don't always realise that. But they are all floating. They're kind of nobody will lend you a fixed rate on those sorts of mortgages. So we'll get back to them later. But if you're
Quick question, sorry. If
Yeah.
the floating rate was lower than the fixed rate, why wouldn't you
Yes.
just put everything on floating and wait till the opposite was true?
Well, yeah, because you could change from floating to fixed without much of a penalty, probably. Maybe if the banks don't like it, they probably find some way to charge you some sort of fee to do that. But yeah,
But the very point of floating is that it's not a fixed term, right?
that's right. Yeah, it's just a 30-year mortgage or a 20-year mortgage or whatever it is. I have to ponder that one, actually. Yeah. So if you're listening to this, though, and you think, well, yeah, look, I might put some on when my mortgage term is up, I might put some on 1 year and some on 3 year and perhaps a bit on floating. And so I asked Bruce Patton, who's a really helpful mortgage advisor at Loan Market, and he answers my question straight away, and he's really good. So I said to him, well, would it be hard to, next time your term is up, to go in and say, this time around I want some for 1 year and some for 2 or 3 and some on floating? Will that cost a lot of money to do that, and will it be a lot of hassle? And he said, no, usually it's fairly easy, and usually there's no fee. Unless you're extending the term of your loan, and some people are doing that right now. We're not talking about the 1 year term, we're talking about the 30-year mortgage or the 25-year mortgage. If people are really struggling to pay because interest rates have gone up, or perhaps they've lost their job or something, and then they want to extend the life of the mortgage, then there are more fees to do that because it's more complicated. The bank's perhaps taking on more risk and wants to reassess your situation. And if you're moving to revolving credit or one of those fancier ones, then it does cost money. The bank will make you sort of apply all over again, really, to reassess your situation because it's somewhat higher risk for them, I gather. And and he made an interesting warning about this. If you're thinking, look, I think I would quite like to put at least some of my loan on revolving credit or one of the other ones, which just basically means you can use the money that's sitting around in your bank account to reduce your interest. As I say, we'll get back to that in more depth before the end of the year. But he says, Bruce Patton said, if that happens and the bank says, okay, you've got to make a whole new application. I keep on doing that, sorry. Making a whole new application, then they may not lock in the rates at the current time. They're saying this is going to take a little while for you to reassess your situation. So we won't guarantee that the current rates will stay going. So by the time you reapply and get all okays, the rates might have gone up in the meantime. So Bruce is sort of saying to people, warning them that if you want to go through that sort of process of moving to a different type of mortgage and it's going to take a while, talk to the lender about locking in the current rates before you do that.
Okay.
So you don't get caught out. But when I looked in the end, so we've got Bruce Patton, mortgage advisor, and we've got Tony Alexander, who's an economist. And I looked at, okay, what are they recommending at the moment? They're both sort of saying fix some for 1 year and some for 18 months or 2 years. This is for most people because they seem to think rates will fall sometime reasonably soon, although maybe not till 2024, but you want to be having some of your money maturing so you can get those lower rates as they're coming through. But of course, that's just another forecast that could go out the window.
Yeah, I think it was going to be end of 2023 until those new inflation figures came out this week.
That's right. And we just see how things change so rapidly. And I mean, if ever we saw it was with the pandemic. No one ever saw that one coming.
Yeah.
And what that did to various economic numbers. So,
but yeah, imagine if you got, 1 year or 2 years at 5.5%, you think, oh man, that's going to sting, and then you lock it in, and then they go up to 7 or 8%.
Yes.
You think, oh, thank goodness, I wish I put more on it.
Because they've been in their teens. Back when I first bought a house, it was way, way higher. One other point that Bruce made was, if your budget's really stretched, you might want to go for longer than 1 or even 2 years. You might want to go for, say, a 3-year rate, even if it's a bit higher, because then at least you know where you stand in this funny environment where no one knows what's going to happen. You could say, well, I'm going to go for 3 years and then I know exactly what I've got to pay for the next 3 years.
Gives
regardless.
you certainty.
Yes, and that's of quite a lot of value to a lot of people, especially if you're really struggling to get that mortgage payment made. Yeah. People, though, probably can afford, most of them probably can afford to pay these higher rates because the banks, when they were giving them the loan a few years back, would have assessed their ability to pay a higher rate. The banks know that the rates might go up. And so when you're applying and the rates are 2%, they're having a look to see if you could actually pay at 5% or 7%.
The old stress test.
Yes. And so if people are struggling, they might think, well, the bank reckons I can do it, so maybe it's just a case of not eating out so much or something.
Thanks, Mary. Hey, great to have you in.
Thanks, Jesse.
Mary Holm on how to think about mortgage rates and mortgage terms in this era of volatility.